All the finance gurus talk about 401ks as if they are the holy grail, and they have been the recommended go-to retirement savings vehicle since the 1980s. But are they as great as they have been touted in comparison to other products? Well, today I'm going to compare 401ks to Index Universal Life, and I'm going to talk about the similarities, how they differ, and how they can complement each other to build lasting financial security. So grab your notebook and something to write with because class is in session. And so real quick, if you are new to me or to the channel, my name is Katrice, and I am a licensed health and life insurance broker, paralegal, and your wealth architect. And I help women entrepreneurs and professionals to grow, protect, and secure their finances and build a financial legacy that they can be proud of. All right, so let's jump into it. Now, before I get started comparing the two products, I want to ask you a few questions that I want you to seriously think about if you have a 401k or if you are looking to get a 401k. Okay? So number one, if you have a 401k, do you think that it will alone secure the retirement lifestyle that you deserve? Okay. Number two, do you think it will fund your dreams or just keep you comfortable and wishing that you could do more? And then number three, have you considered how much of your savings will go towards the taxes that will now be due once you start withdrawing? Okay, so I want you to seriously think about those. If you want to answer in the comments, you can, but seriously think about that if you have a 401k or if you are looking to start saving in a 401k. Okay, so when you're planning for retirement, it is essential that you understand how your money is taxed, and more importantly, when it is taxed. Okay, and so this is why it's important to strategically balance your contributions so that it creates greater flexibility and maximizes your retirement wealth. Okay. All right, so let's get into the details of both products. Okay, now before I get into the differences, let's go over the similarity, and that is they can both be used for growing your wealth and planning for retirement. Okay, and that's where the similarities end. All right, so now let's first talk about 401k plans. Okay, the key features, and so it's employer sponsored. Okay, which means it's typically set up by an employer, and then the employees can choose to participate. And some employers offer a matching contribution where they will contribute a certain percentage of the employee's salary to the account, often based on the employee's own contributions. Okay. Another key feature is pre-tax contributions. So you contribute a portion of your paycheck to the 401k account before taxes. Okay, so it comes from your gross income. It's tax deferred growth. So the money in the 401k grows tax deferred. So you don't pay taxes on the investment gains until you withdraw the money which is typically in retirement. It also has contribution limits, and these are set by the IRS. And so for 2025, the contribution limit is $22,500 per year for those under 50, and $30,000 for those 50 and over, with a $7,500 catch-up contribution. Okay, so the reason it's $30,000 is because you get that $7,500 catch-up contribution. Okay. Now the 401k, the investment options. The 401k plan allows you to invest in a variety of assets such as mutual funds, stocks, and bonds. The investment choices and options are typically offered through a plan administrator with varying degrees of risk and return. The withdrawals and penalties. So withdrawals are typically not allowed until after age 59 and a half without penalty. If you withdraw funds before that age, you will face a 10% early withdrawal penalty in addition to paying regular income tax on the distribution. Okay, yes, you will, because I had to do that. But this was back when I was like in my early 20s. I ain't really know nothing about no 401k, and nobody really explained it to me. And so when I left a job, one of my jobs, I left and I didn't know anything about rolling it over or nothing like that. So I just cashed it out. And when I filed taxes that year, I had to pay a nice little penalty. Now there are some exceptions to the penalty. Okay. So like permanent disability, certain medical expenses, or purchasing a first home. Now that's for IRAs, not 401ks, if you want to purchase a home. So if you have a traditional IRA and you want to withdraw money for purchasing your first home, then you can, but not with a 401k. Also, required minimum distributions. So after you turn age 73, the IRS requires that you begin taking required minimum distributions from your 401k that are taxable as income. And then the vesting. If your employer offers a matching contribution, then you may need to vest, which means earn the right to keep the employer's contributions after a certain period. And the vesting rules vary by employer. All right. So that is the key features. And so let's get into the pros and the cons of a 401k. So the pros are the tax advantages. Okay. The contributions are pre-tax, which lower your taxable income in the year that you contribute. And then your investments grow tax deferred, so you don't have to pay any taxes until you withdraw. Okay. So that does help you out in the now. Okay. Another pro is the employer matching. And so if your employer matches, this is providing you free money, which can greatly accelerate your retirement savings and growth. Okay. Automated savings. So your payroll deductions make savings effortless and consistent, which helps to support disciplined financial habits. 401ks allow significantly higher annual contributions compared to IRAs, which helps high earners to save more efficiently. And then many plans offer diverse investment options, which allows for customization based upon your risk tolerance. Okay, so those are the pros of a 401k. And so now let's look at the cons. The first one is the future tax liability. So while you are deferring now, okay, which is helping you now, withdrawals in retirement are taxed as regular income, potentially at higher rates than anticipated. It's limited liquidity, and so early withdrawals trigger taxes and a 10% penalty, limiting flexibility when you have an emergency. You also got another con is the market risk, and 401k investments are exposed to market volatility and returns are not guaranteed. And then there's limited control. Plan investment options can be restricted by your employer, limiting your ability to choose preferred investment vehicles. And then the last con is the required minimum distributions. Okay. And so now let's get into talking about understanding the key features of Index Universal Life. So one is the death benefit, because it is a life insurance policy. It provides a death benefit to your beneficiaries upon your passing, and this benefit is tax-free, which can provide financial protection for your loved ones. It has cash value growth, and so the cash value within the IUL policy grows over time, can be used for various purposes, including loans or withdrawals. And unlike traditional universal life insurance, the growth of the cash value in an index universal life is tied to a stock market index like the S&P 500. And so this means that the cash value has the potential to grow more than a fixed rate universal life policy, but it's not directly invested in the stock market. So it's less risky than investing in equities. Index-linked interest. And so the interest credited to your cash value is based on the performance of a specific index, such as the S&P 500. However, the cash value doesn't directly participate in the stock market. And so the insurer uses a participation rate, which is the percentage of the index's return credited to the policy, and a cap rate, which is the maximum return that you can earn on your cash value in a given year. Okay? And so, for example, if the S&P 500 rises at 10% in a year, and your policy has a 70% participation rate and a 12% cap, then your cash value would earn 7%, but you can't earn more than 12%, even if the index performs better than that. Okay. Another key feature is the downside protection. And so one of the most attractive features of the IUL is its downside protection. And so if the index performs poorly or has negative returns, your cash value in the policy will not decrease. Okay? And so the insurer usually guarantees that your cash value won't decrease below a certain floor, often 0%, or sometimes 1%, but mostly I've seen 0%, ensuring that you don't lose money due to market volatility. Okay. Now, IULs are also flexible premium policies, meaning that you can adjust your payments over time. The flexibility is especially useful if your financial situation changes. And so you can increase or decrease your premiums, or even skip a payment if your cash value is sufficient enough to cover the cost of insurance and other fees. Another one of the benefits of IULs is that the cash value in the policy can be accessed through loans or withdrawals. Okay. Now, when you take out a loan against your IUL, the loan is not considered taxable income. Okay, so you're essentially borrowing from your own funds, and the funds can be used for anything you want, paying for college, buying a home, or funding retirement. But loans will accrue interest, and any unpaid loans will reduce the death benefit. Now, the way withdrawals work in an IUL is that they are tax-free up to the amount that you paid into the policy, and they are treated as loans within the policy and not taxable income. Okay, so this means that you are withdrawing essentially from your own money. Okay, so it's not withdrawing from the gains, it's withdrawing from the money that you've paid into the policy. Okay, and so that's why it's not taxable. Okay, all right. And then the cost of insurance. The policy's cost of insurance is deducted from the cash value and typically increases as you age. Now, these costs can be a significant factor in the policy's overall performance. And so it's important, first of all, it's important to make sure that it is structured properly. Okay. And then you also want to regularly monitor and adjust premiums to ensure that your policy remains in force. Okay. And so you need to make sure that you are working with somebody who is qualified, who understands how to properly structure an IUL, because if it is structured improperly, you could potentially lose your money, and you're not going to be a very happy person. Okay. Now, also, the growth of the cash value is tax deferred, meaning you won't pay taxes on the interest or the gains in the policy as long as the money remains in the policy. Okay. And additionally, the death benefit is typically income tax free for your beneficiaries. Now, I know that sounds a little weird, the tax deferred, when I just explained the withdrawals, right? But it's like if you watch my video that I just posted this week on Monday, on May 20, what was Monday? The 19th. The thumbnail says avoiding retirement surprises, because in that I break down the different ways that your money is taxed. So go watch that, and then this will make a whole lot of sense to you. But if it's not tax deferred, so that would be something like a savings account where you're going to pay interest, you're going to pay taxes on the interest that you receive from the growth of your savings account. But in the IUL policy, that doesn't happen. So you don't have to pay taxes on the gains. Okay. So that's why it's tax deferred, and when you withdraw, it's tax free. Okay. Let me know if that makes sense in the comments, and if it doesn't make sense to you, ask a question, ask me, and I can clarify for you. Okay. All right, so here are some pros of Index Universal Life. The first one is potential for higher cash value growth. Because it is the ability to link cash value growth to a stock market index offers the potential for higher returns compared to traditional whole life or universal life policies. And then the downside protection. And so if the market drops, your cash value is protected from losses. Another pro is the flexible premiums and the benefits. You have the flexibility to adjust your premiums, the death benefit, and even make use of loans and withdrawals against your policy's cash value. And then the tax benefits. Okay, the cash value grows tax deferred, and the death benefit is tax free. Now here are some cons of Index Universal Life. So the first one is the cap on growth. And so the cash value does have the potential to grow based on market performance. There is a cap on how much you can earn in any given year, limiting the upside potential. It is complex. IULs can be more complex to understand than other life insurance policies, with various features like participation rates, cap rates, and floor rates. And so it can be challenging for policy holders to fully grasp how their cash value grows. And so that's why it's very important that you work with somebody who knows what they're doing. Also, another con is the cost of insurance. And so as you age, the cost of insurance tends to rise, which could eat into your cash value if it is not properly managed. And then the fees and the charges that are associated with managing an IUL. Okay, and so these can be the administrative fees, the cost of insurance, and any surrender charges should you cancel the policy early. Okay. All right, and so I want to get you a piece of paper and write this down, so you can do kind of like a side-by-side comparison of the two products. So when it comes to the tax advantage of each, Index Universal Life is tax deferred gains and tax-free loans and withdrawals. 401ks is tax-deferred contributions, and then it is taxable, but it's taxable at retirement when you withdraw. Okay. Now, market risk. IULs give you protection from losses and capped growth. 401ks are full market exposure, higher potential to grow, but also at losses as well. And then when it comes to access to funds, IULs are flexible with the loan and withdrawal options. And then the 401ks have limited access and penalties for early withdrawal. And then for the contribution limits, higher flexibility and fewer IRS limits with the IULs. And then the 401ks have IRS imposed annual contribution limits. And then when you're looking at it as far as estate planning, the death benefits pass tax-free to beneficiaries with the IUL. And then with your 401k, the inheritance to your beneficiaries would be taxable. Okay. All right. So when it comes to who may be, wanting to get into IUL, and who a 401k may be better for. 401ks are good for people who have moderate to high risk tolerance. So if you are comfortable with your money being directly in the market, then a 401k would be good for you. If your employer matches your 401k, then you may want to take advantage of that, because essentially it is like free money that you're getting to go towards your retirement. If you value the immediate tax relief, so because it lowers your taxable income through the pre-tax contributions, this could benefit you greatly during your earning years. If you prefer simplicity and automation, because it is the automatic payroll deductions, easy account management, and straightforward investment selections, then it might be good for you. And then also, if you are in your early to mid career professionals, and so 401ks are really good for younger people who have ample time to absorb market fluctuations, accumulate compound growth, and fully leverage the employer match. Okay. Now, when it comes to IULs, these are good for people who have low to moderate risk tolerance. They prefer safety, stability, and protection from market volatility. Okay. If you are seeking tax-free income, and so if you are aiming to minimize your future tax liabilities, especially if anticipating higher tax brackets during retirement, then an IUL is something you want to look into. If you are an entrepreneur or you are a very high earner, then you are going to want to look into an IUL because they have no contribution limits. If you are wanting the flexibility, they're wanting having the access to your funds without incurring any tax penalties, and this would be good for you, especially for entrepreneurs and business owners with fluctuating income streams. And then if you are wanting to leave substantial tax-free benefits to your beneficiaries, ensuring your family financial security and intergenerational wealth, then an IUL would be what you want to look into. And then mid to late career stage professionals that are looking to supplement their existing retirement strategies as their income and net worth rise, particularly those who started retirement planning later, or those who are wishing to diversify. Okay. Now, if you are mid to late career stage and you want to start a 401k, you definitely can. There's nothing stopping you. But you may want to also look into an IUL as well. Okay. And so remember when I said earlier in the video that it's essential to understand how your money is taxed, and more importantly, when it's taxed? Well, when you combine having a 401k with an IUL, it is a strategic move that allows you to reduce your tax liability during retirement, thus keeping more of your wealth right where it belongs, with you. And so let's talk about how these two products would complement each other, okay? All right, so the first way is through tax diversification, okay? So you could blend your pre-tax contributions with the tax-free retirement income. So you can lower your tax liability as you are contributing to your 401k while you're younger, okay? Which, by you lowering your tax liability now, then you would be able to, because there's less taxes you're paying, which is more money you're keeping in your pocket, so you'll have more money in your pocket to invest in an IUL, which then when it comes time for retirement, when it's time to withdraw from the 401k and you have to start paying taxes, the income that you are receiving from the IUL can help offset the taxes that you're having to pay now from your 401k, okay? Now, another way is risk management. You can stabilize your portfolio by balancing the market exposed 401k funds with the safer IUL asset, because the IUL is not participating directly in the market, okay? And then also liquidity planning. And so you can leverage the IUL's flexible access to funds before and during retirement without triggering tax events, okay? And so if something was to come up and you know you can't dip into your 401k without being penalized, but you have an IUL, you can dip into that and there'll be no penalties, and it's tax free, okay? All right, so this a combined, having an IUL and a 401k together, this combined strategy is ideal for women who want diversified tax strategy, who want a diversified tax strategy, who are seeking balanced risk exposure, who are high earning professionals or entrepreneurs, who desire holistic financial security, and you may be a middle to late career professional with financial complexity. So you're somebody who wants wealth accumulation that requires more sophisticated strategies that will be addressing taxes, liquidity, estate planning, and retirement distribution phases comprehensively, okay? And so having both working together for you is a great way to help you to offset taxes from the 401k, and also have that liquidity if something were to happen, to be able to dip into the IUL and take tax-free withdrawals or loans, okay? All right, so here are some three actionable steps that you can implement to get started if this is something that you want to implement in your retirement wealth strategy, okay? So the first thing you want to do is you want to review your current retirement wealth strategy, okay? Are you diversified in both strategy and taxation, okay? People tend to forget the taxation part, and that is very, very key, okay? Number two, you want to consider your risk tolerance and your desired retirement lifestyle. Does your strategy match your goals? And then the third one is to speak with the financial professional such as myself, who understands the nuances of both an IUL and a 401k. Okay. Alright, and so that is what I have for you in this video. And so if you have made it this far, thank you so much for watching. My goal is to always provide practical, actionable financial advice to help you to take control of your finances and your future. And so if you would like to book a consultation with me to discuss your wealth retirement strategy, if you want to get more information on how an IUL would be able to help you to reach your wealth and retirement goals, then you can do so using the link in the description of this video, and it is also on the channel's homepage. Okay. If this video was valuable to you, please do give it a thumbs up and share it out with someone, your business bestie, who could also use this info, and also subscribe if you like the content that I provide on this channel. Also drop a comment in the comments below and let me know which action step you will take first. I love to see you guys' comments and thoughts. Alrighty, and so remember, the way to secure your financial future is to protect it today, because no one is coming to save you tomorrow. Alright, have a good one. See you in the next video.